Cash, bank reconciliations and petty cash. Using an example, we will walk through the bank reconciliation process and the petty cash process. Print this page for reference when we go through the bank reconciliation example because you'll need the information from this page in order for it to make sense. So here we have a bank statement as of April 30th and a general ledger balance as of April 30th. These should agree as much as possible in order for the bank reconciliation process to make sense. We have a beginning balance on the bank statement, and then we have some deposits that were made by this company, as well as an electronic funds transfer, a customer collection that the bank made on behalf of this company in the amount of $100, and then interest that was earned on the account for this company in the amount of $30. There were service charges taken out, $20, and then we have the checks that cleared the bank. This check was related to the prior month, and these checks are related to the current month and represent all of the checks that were written by the company. Then we have other deductions from the bank statement, an electronic funds transfer where the company paid a waterworks using an electronic funds transfer. And then also we see here that the bank has an NSF check. This is a check that the company deposited with the bank that was from one of its customers, and when the bank tried to collect from that customer, the customer's account did not have enough funds in it, so the bank returned it to the company, and so an NSF check was deducted from the balance in the amount of $1,200. So we have all of the additions, all of the subtractions, and this is the ending balance of the bank. Now let's look at what's going on in the general ledger for the company. It had a beginning balance and then the deposits that were made, payments that it received during the month, and then checks that it wrote during the month. Now let's match these between the bank statement and the general ledger. We can see that this deposit agrees, this deposit agrees, and this deposit agrees. However, the $9,000 deposit has not yet made it to the bank statement, so it will be a reconciling item. Next, let's look at the checks the company has written. We can see that this check has made it to the bank, this check has made it to the bank, as well as this check for $150, but we see the check that they wrote for $2,000 has not yet made it into the bank. The client or whoever they paid, or vendor or whoever they paid, has not yet presented it to the bank. And we can see that this does not represent a check that was written in the current month. It represents part of the beginning balance in the general ledger for this company. So we add up all of our debits, add up all of our credits, take the smaller from the larger, and we have an ending balance. Now the reconciliation process is reconciling between these two balances, and most often they won't agree because there will be timing differences between the time that the bank receives items and the time that the company records items in its general ledger. So let's look at a bank reconciliation. So this was the ending balance in the bank for the bank statement. Now we're going to add the deposit in transit. This is a deposit that was recorded on the company's books, properly recorded on the company's books, but it just hasn't been made it hasn't made it into the bank statement yet, and the bank hasn't received this deposit yet. So it's seen as a reconciling item, which is a timing difference. Next, we have the check that the company wrote and recorded in its general ledger, but the vendor who they wrote the check to, or whoever they wrote the check to, has not yet presented it to the bank. So there will be a timing difference here. And there could also be a bank error. The bank could possibly make an error. They're very rare, but they do happen. So traditionally, you will see three items on reconciling the bank to the adjusted bank balance. Those reconciling items will be adding deposits in transit, subtracting any outstanding checks, and looking to see if the bank has made any errors. Now, this adjusted bank balance must agree when we do the other side of this reconciliation. When we look at the books of the company, these two must agree. So I always advocate to do this side of the reconciliation first because there's fewer reconciling items that you have to consider. There's only 3 items that you would consider. And so those three items are all going to be the timing difference, two timing differences: deposits in transits and outstanding checks. No journal entry is ever required for this because the bank is just not in sync with the books of the company, and therefore these just represent in the reconciliation items that you're using to bring the bank balance up to date with the book balance for legitimate transactions. And if there ever was a bank error, you would just simply call the bank and ask them to correct it. Now, let's look at the other side when we're going to take the general ledger ending balance and now reconcile it to the ending adjusted bank balance. So here is our general ledger ending balance, and now we're going to add items that we found out from looking at the bank statement. So we didn't know about these till we got the bank statement, but now that we have them, we need to record these items because they're legitimate transactions that the company must recognize. So we here have the electronic funds transfer, the receipt from the customer in the amount of $100, and then the interest it received from the bank account. So that will be $30. And we're going to subtract any bank service charges, $20. These could be check printing fees, any one of a number of different charges that they would be using the bank for, that the bank would be charging them for. We also have the electronic funds transfer, the payment to Waterworks, that we must also record in the general ledger. And then the NSF check. We won't know about these till we receive the bank statement. And there also could be NSF check fees associated with NSF checks. Typically, a company will charge the customer whose check was NSF and charge them for the fees so that they aren't absorbing the cost which is associated with assuming that the customer had given them a good check. Now, here we also could have any journal entry errors. So there could be some book errors when you're comparing items between the bank statement and what you have recorded in the general ledger. Say, for instance, in the general ledger, you have something recorded as $90 when it's actually $9,000. And then we will have the adjusted book balance. So it'll be all the additions and subtractions as a result of reviewing the bank statement. These will always agree. Now, each item on this side of the reconciliation requires a journal entry. We have to record the fact that for this customer that we've received the money. We have to record the fact that we've received interest, subtracting out any expenses, the bank service charges, any expenses that we paid through electronic funds transfer, utilities expense, and any NSF check. We must update our accounts receivable records for that. So each item on this side requires a journal entry, and if there ever are any book errors, I advocate that the book error should be reversed and a corrected journal entry posted. It's just much cleaner and easier to explain to someone who you're trying to show them why there was an adjusting journal entry correcting an error. Now, let's look at petty cash. When a petty cash fund is established, the journal entry is a debit to petty cash because we're establishing this fund, and we're going to take this out of cash, a $300 credit against cash. Now, typically what will happen is this check will be cashed for cash, $300 given to a petty cash custodian who will maintain a locked petty cash box. Each time petty cash is withdrawn for an incidental expense, the petty cash recipient and the petty cash custodian sign off on a pre-numbered petty cash voucher which is dated, and evidence of the transaction is attached. So this should be custodian. So I don't know what a custodial dial is, but anyway. All right. So when cash is withdrawn, and usually these are just for incidental expenses, just to have the cash on hand and not have to write out a check. Say, for instance, we're looking at one that's for $6.75. Well, you don't want to write out a check for $6.75 each time, so you just have petty cash on hand. So the person who receives the money, as well as the person who's the custodian, will sign off on this pre-numbered cash voucher. So this is the pre-numbered cash voucher. They're traditionally in like a little book. This will be the name of the company, and then what there will be an explanation of what it's for. So when you're writing out the journal entry, you'll know what to charge that to and what the explanation is, the date on which the petty cash was given, and the general ledger account associated with the disbursement, and then the amount of the disbursement, and then it'll be approved by and then received by. At the end of the month, the cash and the locked petty cash box is added up. Then it's compared to the general ledger balance and a difference derived. So here's the petty cash to account for. So we have a petty cash fund in the amount of $300, and you add up all of the cash in the petty cash box, and we see that we have $220 on hand. So this represents the projected voucher. So all our vouchers should agree to the $80. So we should have $80 in vouchers, and also this represents the reimbursement total. So we have cash on hand of $220, and now we have to reimburse the fund for $80. Now let's look at what happens next. This difference should equal the total of the petty cash vouchers. So let's see if they did. We have voucher number 9 for $675, number 10, 11, 12, 13, and 14, and you should also make certain that the sequence has integrity, and that if there is one of these that is voided, that it should be marked voided. So here we have all of the petty cash vouchers, and we add them up, and we see that they add up to $78.11, which doesn't agree to $80. So there's a difference, cash over and short, of $1.89. If there is a minimal difference, it is considered to be cash over and short. However, if there's a large difference, an inquiry will ensue, especially if there's a consistent difference of $5, $10. People will be concerned that things are not being recorded, or because it's a box full of cash. Cash is pretty anonymous, that somebody's walking off with $5 and $10. So now let's look at this. When the petty cash is reimbursed, the difference between the cash on hand in the petty cash box and the general ledger total equals to the amount to be refunded to petty cash. So make certain you're paying attention to this, because this is what is going to be refunded to petty cash. It represents the funds needed to bring the cash in the petty cash box back up to the amount that should be on hand for petty cash. Now let's look at the journal entry. Petty cash. The receipts for expenses are added up and categorized, and a journal entry is prepared to reimburse the petty cash fund. So we saw here the projected voucher, and then we looked at all of the vouchers. I've highlighted these in pink because they're going to be categorized all together as cleaning supplies. So you don't want to write out a journal entry where you're just doing each one of these individually. A lot of times they're added up and categorized. So you're going to be debiting cleaning supplies expense for $19.85. Then we have some transportation expenses. So perhaps somebody took a cab to work and they were reimbursed out of petty cash. Then there was postage expense. They took petty cash out and went to the post office and got postage. And then there was a miscellaneous expense of $3.26. Here we have the cash to be reimbursed, and so here we have cash over and short. And so now we know that our journal entry is in balance, and this represents what we would have by way of a journal entry. Now, an important note: cash is credited. Cash is credited, not petty cash. Petty cash is a general ledger account, is never part of a journal entry unless the petty cash fund is established. So remember, we debited petty cash and we credited cash for $300 when we first established this petty cash fund. If they would choose to decrease or increase the petty cash fund, then there would be a journal entry in order to decrease the petty cash or increase it. But that's the only time that petty cash would be part of a journal entry, is only in these instances.